Welcome back to this session for CMA final students. This is your paper number 20, section B, business valuation. And now we are going to revise your study note number 7, that is valuation of assets and liabilities. In this chapter, we will talk about valuation of inventory, valuation of investments, valuation of bonds, valuation of equity shares, valuation of goodwill, valuation of human resources assets, valuation of brand of a company, valuation of economic value aided by the company, etc. So we'll be talking about various types of assets that for various purposes, how to make valuation of different types of assets and liabilities. And I'm your friend Tarun Mahajan, a chartered accountant, a chartered financial analyst from CFAI USA, and a registered valuer of securities or financial assets. That is, practically, I do practice valuation of equity shares, preference shares, complex debentures, and many other securities. So here in revision also, I'll try to give you some flavor, a little bit of flavor of the real life, but mostly we will focus on examination purpose because this is a quick revision. Let's start with valuation of inventory. So being a student of cost accountancy course, this is like a child's play for you. How to make valuation of inventory using first in first out method, last in first out method, and the weighted average method. Accounting standards in India, they do prefer that you should use either the first in first out method or you should use the weighted average method. And LIFO, we say, oh my god, LIFO, we don't want to use it. That remains in the last in our priority list. But if I talk about US GAAP, United States of America generally accepted accounting principles, they do prefer LIFO over FIFO. Because, practically there is one advantage of LIFO, that it is more conservative than the FIFO. Like under inflationary situation where the price of goods and services are rising day by day, month by month, year by year. Suppose my opening inventory was valued at 100 rupees. During this year, I keep on making purchase at 101, next month 103. Next month, my purchase price is 107 rupees. Next month, 108 rupees. Next month, 110 rupees. Now, my last purchase was at 110. If I'm using LIFO, last in, first out method, in that case, I will charge the latest purchase to the profit and loss account, and under inflationary conditions, latest purchase will be most expensive. So the most expensive purchase will be charged to the P&L account, will be charged to the cost sheet, and that way my profitability will remain in control, it will reduce. And the earlier purchase, the cheaper purchase will remain in stock and it will be shown in the asset side of the balance sheet. So that's not fair value accounting, I'll say. That's the conservative accounting. So that is how they do prefer LIFO over FIFO or weighted average. Anyways, let's do this very simple question. It says that oil company is a bulk distributor of high octane petrol. A periodic inventory of petrol on hand is taken when the books are closed at the end of each month. Okay, so we are making valuation of inventory at month end. The following summary of information is available for the month of June 2016. Sales during the month is rupees 9,45,000. General administrative cost is rupees 25,000. I think these two information are going to be useless for us. Because while making valuation of inventory, we are not interested in sale, we are interested in purchase price and purchase units or opening inventory. Opening stock. So currently this seems to be not useful. If needed, I will consider it. Opening stock is 1 lakh liters at the rate of rupees 3 per liter. So it's valued at 3 lakh rupees. Purchase including freight on June 1st. 2 lakh liters were purchased at 2.85 per liter. Then on June 30th, again 1 lakh liters were purchased at 3.03 rupees per liter. So I should write it like this. And closing stock on June 30th is 1,30,000 liters. Okay, so opening stock was 1 lakh, purchase was 3 lakh, total was 4 lakh, and out of 4 lakh, you're saying 1,30,000 is in stock. It means 2,70,000 units are sold. Fine, perfect. Compute the following data by FIFO, weighted average, and LIFO methods of inventory costing on June 30th. It's a very simple question. So let's make a statement showing value of closing stock or value of inventory as on 30th June 2016 under FIFO, weighted average, and LIFO methods of pricing. Look here, if I'm following FIFO, then this 1,30,000 unit is the latest purchase. So 1 lakh unit should be valued at 3.03 and remaining 30,000 units should be valued at 2.85. So look here, 1 lakh liters at 3.03 is 3,03,000 and 30,000 liters at 2.85 is 85,500 rupees. So under FIFO, look here, this is FIFO column. The value of inventory appears to be 3,88,500 rupees. Great. Then let's talk about the weighted average method. So this is the weighted average method. Now here I need to calculate weighted average of opening stock and purchase. So weighted average of 3 rupees, 2.85 rupees and 3.03 rupees. Weighted average of 3 rupees, 2.85 and 3.03 when the weight assigned is 1 lakh, 2 lakh and 1 lakh. So here I calculate the weighted average like this. 1 lakh liters at 3 rupees opening stock, 2 lakh liters at 2.85 June 1st purchase, then 1 lakh unit at 3.03 June 30th purchase. Total of weights is 4 lakh and weighted average is 2.9325. Let me check. Is it 2.9? I think this is 2.9075. Let's cross check this. So this is simple. I'll say first of all, 3 lakh rupees I should take. Look here. 3 lakh rupees I'll keep in memory. And then 2 lakh into 2.85. That's 570. I'll keep it in plus memory. And then 1 lakh into 3.03. 3 lakh 3,000. Again in plus memory. So memory recall is 11 lakh 73,000. Yeah. Divided by 4 lakh units. 2.9325 it is. This is correct. 2.9325. And now 1,30,000 units are in stock. So multiplied by 1,30,000. 381,225. 2.9325. 381,225. These questions I have taken from your own study material, like this is illustration number 4 from your study material. But I have corrected the question as per the requirement. Sometimes there were error in the question or in the solution, so I corrected those errors in solution. And sometimes I have extended the question with my own numbers so that I can explain concept to you in a better manner. This is weighted average method, 3,81,225. If you are following LIFO, last in, first out, then the first 1 lakh unit should be in your stock at 3 lakh rupees. And 30,000 units should come from this purchase of 2.85. So look here, 1 lakh liters at 3 rupees per unit, it's 3 lakh under LIFO. And 30,000 units at 2.85, that is 85,500. 385,500. This is LIFO valuation. 381,225 is the weighted average valuation. And 388,500 is the FIFO valuation. Right? Easy question. Now let's check one more question on valuation of inventory. You know, as per accounting standards, we usually make valuation of inventory at cost or realizable value, whichever is lower. Cost means your cost of purchase, including freight, etc. And realizable value means the sale price minus sale expenses. Whichever is lower is considered to be the value of inventory for the sake of accounting. This is again conservatism. This is not fair value accounting. This is conservatism, that you take inventory at lower of the cost or realizable value. The XYZ Machinery Limited requests you to ascertain the amount at which inventory should be included in the financial statements for the year 2015-16. Okay. The value of inventory as shown in the books of accounts is rupees 12,50,000. Fantastic. 12,50,000 is the amount of inventory shown in books of accounts. This is the current book value. I'm not saying this is cost. I'm not saying this is realizable value. I'm saying this is the book value. Because the book value may be either cost or it may be realizable value. To determine the net realizable value of the inventory as at 31st of March 2016, on a test check basis, you had selected several items whose book value was rupees 3,50,000. Okay. Now this is fantastic that you are making a test checking, and in this test checking what you are doing is, I'll tell you, that book value of your inventory is 12,50,000. Out of which you have chosen a sample of 3,50,000. So what is not included in this sample is ₹9 lakh. So this is part of your sample. So out of total book value, BV, that stands for book value. Out of total book value of 12,50,000, you have chosen a sample of 3,50,000. You had selected several items whose book value was 3,50,000. You ascertain that except for item A to C mentioned below, The cost was in excess of the realizable value by 29532, or you can say that realizable value is less than the cost. The difference is roughly 30,000 rupees. So out of 3,50,000 also, now there are some special items mentioned in A to C, and rest of the inventory is to be reduced by 29532. Apply this percentage downfall. Like I have made this correction in the question, it's not there in the original question. Apply this percentage downfall on inventory which is not included in sample. Okay. So now out of 3,50,000 also, it should be divided into two parts. One is item A to C. Item A to item C, which we need to take care separately. And remaining should be reduced by roughly 30,000 rupees. While reading the question, if you read it hurriedly, then your first impression about interpretation of the question will go wrong. And if your first impression for the question goes wrong, then even if you read the question thereafter for 5 times or 10 times, every time you will read it wrong and interpret it wrong. So I am giving you one very important, very simple exam tip, that while reading the question for the first time in the examination, devote proper time. Read each single word carefully and interpret it, because whatever mind you make after reading the question, then it is difficult to change your mind. If your first interpretation is wrong, then you go on with the wrong interpretation even if you read it second, third time. So this is how we have classified our inventory. Now the next thing. The following items require special treatment. Okay. These are ABC items. One machine, that is one inventory item, which has a cost of rupees 1,30,000, can now fetch rupees 1,15,000. So cost or realizable value, whichever is lower, this item A should be valued at 1,15,000. Okay, this item A should be valued at just a minute. Oh, this pen is disabled. Just a minute. I'll enable it. So I was saying that this item A should be valued at 1,15,000 rupees, right? Let me save this file first. Now look at this. So one machine cost rupees 1,30,000 can now fetch rupees 1,15,000. Cost or realizable value, whichever is less. Fine. So you should take it at 1,15,000. It was priced at rupees 70,000. Oh. So the book value at which it is included currently is not 130. The book value at which it is included currently is 70. So you can do one thing, that out of this 3,50,000, first of all, you need to deduct 70,000 rupees to arrive at the cost of remaining inventory. Out of sample, if you deduct ABC item, rest will be the book value of remaining inventory. So out of this 3,50,000, an item with book value of 70,000 has a cost of 130 and realizable value of 115. So cost and realizable value, whichever is lower. Therefore, I take realizable value 1,15,000. Now a pump which costs rupees 50,000. Okay, so second item is pump which cost rupees 50,000 was expected to realize rupees 35,000. A special commission of 15% would have to be paid to the broker. So 35,000 should be multiplied by 0.85 because 15% is commission. 29750, right? So this is plus 29750. Writing on a standing screen, then you see the bad handwriting thereafter. And there is no separate book value. So we are assuming that this item currently is included at a book value of 50,000 rupees, right? Now 6 units of product number 1570. This is not amount. This is the item code. 6 units of product number 15710 were in stock valued at rupees 5520 each. Okay. So 5520 into 6. 33120. I need to deduct 33120 from the book value. Selling price is just 4,500. On the top of it, 10% selling commission is also there. So 4,500 minus 10% is 4050. This is the realizable value. 4050 into 6 is 24,300. So here I should add 24,300. So my dear friend, your inventory book value is 12,50,000. 9 lakh currently you are not considering. You have taken a sample of 3,50,000. This sample comprises 3 items A, B and C, which will be included at 1,15,000, 29750 and 24,300 in your books, and their book value should be deducted from the total book value of sample. So 3,50,000 minus 70,000 minus 50,000 and minus 33,120. So now this item has a book value of 196,880. Book value of remaining items. Book value of remaining items is 196,880. And realizable value of this 196,880 is less than the cost by rupees 29,532. So 196,880 is the cost, minus you need to do 29,532. So you just do minus 29,532. This is 167,348. So this book value should be included at a realizable value of 167,348. 167,348. Okay. So now you have 2 items. I'll just highlight it. This is one item at realizable value of item ABC, and this is realizable value of remaining item from your sample. Now the question arises, what is the realizable value of this 9 lakh rupees? For that, the question has given us a guide that this percentage downfall should be applied to 9 lakh also. So 196,880 was book value and downfall is 29,532. So 29,532 29,532 divided by 196,880. 196,880 is the book value of remaining items after deducting special items. Book value of remaining item. And on that, there is a loss of 29,532. So this is 0.15. That is 15%. Okay. So except special items, your sample has reduced by 15%. Therefore, the whole population should be reduced by 15%. So here I should deduct, here I should actually deduct 15% minus 15%. So 900,123 minus 15%. 1,35,000 is to be deducted. You'll be left with 7,65,000. You'll be left with 7,65,000. So this is the whole story now. You're making valuation of inventory. Book value of inventory is 12,50,000, out of which you take out a sample of 3,50,000. This sample has three special items A, B, and C. Book value of those special items is 70,000, 50,000, 33,000, 120. So book value of remaining sample items is 196,880, which is reduced by 29,532. So the realizable value of sample items other than special items is 167,348. Now, as far as special items are concerned, their realizable values are respectively 1,15,000, 29,750, and 24,300. Now, rest of the inventory, if this is reduced by 15% in general, this should also be reduced by 15%. So, in this three parts, when you make sum of these three parts highlighted yellow, you will finally get valuation of inventory. Okay. So taking into consideration only the above mentioned items required special treatment, compute the value of their inventory as on, this line is useless. Compute the value of their inventory as at 31st March 2016, you would consider reasonable. So orally I have solved the entire question, and now I am going to solve it here step by step. Book value of selected items is given. From the given information, realizable value of remaining selected items will have to be found. Then the value of inventory for all items to be included in the financial statement is to be determined. So working showing realizable value of selected items. Selected items means sampled items. Book value of sampled items is 3,50,000. Out of which book value of special items A is 70,000, special item B is 50,000, special item C has a book value of 33,120. So book value of special items within the sample are 153,120. When you deduct it from the sample, you get sample of general items. So sample book value of general items, that is not the special item, is 196,880. On this 196,880, there is a downfall of 29,532. So 29,532 should be deducted from 196,880, which comes as 167,348, and this downfall is actually 15%. So now finally, how to make valuation of inventory. Total inventory 1250, sample 350. So non-sample items are 9 lakh. Non-sample items are reduced by 15%, which is calculated in the above paragraph. This is 15%, which comes to 7,65,000. Then if I talk about special item, first special item A has a realizable value of 115. Special item B has a realizable value of 29750, which is actually less than its cost. See, all three special items, have you noticed that their realizable value is less than the cost? Notice this. This was having a cost of 130, I think, realizable value 115. This was having a cost of 50, realizable value 29750. This was having a cost of some 33,000, realizable value 24 300. Total realizable value of special item 169050. Now, items other than special items in our sample are having a value of 167348. How come 167348? This is simply 196880 minus 29532. So value of all items of inventory as on 31st March 2016 is 11 lakh 1398. That is 765 plus 169 plus 167 added together will become 11 lakh 1398. So yeah, though it's simple, but it's a different question. Cost or realizable value, whichever is less.